This article is rather not a guide to action, but a kind of route map. You will learn why investing skills are so important in the modern world, where to start, and what important principles and rules exist. We will also look at what assets to invest money in for novice investors in order to get a decent income and minimal risks. Investing is a difficult and somewhat dangerous activity, but we will try to make it easier. Inflation, global economic crises, defaults and all that are raging around us. The financial world is too unreliable to rely only on its cheap savings, on the work that robots will do tomorrow, and on neural networks in the state, which may plunge into the abyss of another crisis. Investing, despite all its risks, is not only a way to secure your money, but also a way to financial freedom and passive earnings. In addition to the fact that investing can bring income, it is also a skill that teaches you to analyze any situation very carefully, make responsible choices, think through all your moves in advance, and minimize risks. This point follows from the previous one. If you want to invest in a ready-made business or startup, choose one that is close to your expertise. Do not work with a company if you are a humanitarian to the core. No one can predict the dynamics. No matter what financiers say about their fundamental analysis, there are always black swans. Both positive and negative. Don't rush to sell or buy every time the market turns. Stick to your original strategy. There are a lot of profitable assets now. We will not go into too much detail, but will consider only the main ones. Deposits. The most reliable option, but also the least profitable. Great for a startup, you won't get a lot of revenue, but you will protect your money from inflation. Precious metal. Despite temporary falls, this asset is reliable and shows good profitability. The average yield of gold, adjusted for inflation, in the period from 2003 to 2013 was 7.66%, silver 13.4%, platinum 12.7%. Realty. It has a high yield, up to 65% over 3 to 5 years, and allows you to earn passive income. Among the disadvantages, a high entry threshold and yet greater illiquidity than the same precious metals. In addition, the price of real estate strongly depends on the general economic situation in the country. Investment funds. There are many variations of these organizations, but their essence is the same. You put your money under the management of professional financiers, for which they charge part of the profit. If you invest in a reliable company, you can expect an annual return of 12 to 40% with a comparable level of risk. Businesses and startups. The younger the startup, the more profit you can make. If a young company does not fail, this happens in 80% of cases. This is definitely not an option for a beginner. But the percentage of profit here does not have a ceiling. Securities. This option is very similar to the previous one. Shares of some companies can rise by tens or hundreds of percent, but they can also fall. However, you can use low yield but more reliable government bonds. Digital currency. This is a completely new financial instrument and therefore very unclear and unreliable, but still promising fantastic profits. In some cases, the price increase was more than 1,000% per month, as happened with Bitcoin in 2013. True, his fall was just as loud and fast. Naturally, the above does not exhaust the knowledge that a novice investor needs to possess. Therefore, it makes sense to deepen your knowledge with the help of specialized literature. If you want to seriously plunge into the world of investment, then it is better to do without inventing a bicycle. First of all, you should study someone else's experience. Our selection of books about investing will help you do this. The Intelligent Investor by Benjamin Graham. Just a classic about securities. One of the first books on investment, from which the famous Warren Buffett studied. All About Investing by S. M. Fairber. A very competent and easy guide for beginners. The book is richly written about all types and strategies of investing. The Essays of Warren Buffett. The only book you need on investing. The Famous Guide of the Greatest Investor of All Time. All About Asset Allocation by Richard Ferry. Must read for a novice investor, written by a practitioner. Everything you need to know about diversification and reasonable allocation of investments. The Black Swan by Nassim Taleb. This book is not really about investing, but understanding what is described in it is very important for the critical perception of all subsequent information on this topic. Investing is the only way to protect your money from depreciation, although it is risky. But investing should be your minimum plan and your maximum plan to get a source of passive income. If everything is done correctly and critical thinking is included, then this is quite an achievable goal. Be careful and smart and you will not have to think about retirement. Even if you start with just $1,000, these investments will pay off. If not money, then experience and knowledge. It doesn't matter how much you start with. Investing is a skill. And the sooner you start, the faster you'll learn. Well, small amounts, it is only less risk of losing money due to inexperience. Besides, it's not as complicated as it sounds. Generally, the asset allocation principle is popular, which implies that a non-professional investor pays minimal attention to a highly diversified portfolio. In total, you will need less than a day per year to manage your investments. Before proceeding to the study of financial instruments and analysis of their risk, let's define investment axioms, the failure of which will definitely put you in bankruptcy. We don't promise, but it should help you make money. What do you want from your investment activity? Protect yourself from inflation or ensure a comfortable old age? In the first case, it will be enough to open several deposits and a couple of hours per year to service them. In the second case, you will need to create a reliable portfolio with different sources of income and spend much more time on it. Having a goal is the first step in building an investment strategy. It's simple: set aside a portion of your income every month. Let's say it's 10%. You can do more or less, the main thing is regularity. You can probably live on the remaining 90%, can't you? Google the dynamics of the gold price over the past 50 years. Despite temporary ups and downs, the overall trend shows growth. The same behavior is observed in many other well-established assets, even in the notorious cryptocurrencies. If you have made a 10-year plan, do not sell your portfolio after 2 years because the price of gold suddenly fell by 25%. It is quite realistic that in another 2 years it will grow by 100%. Whatever it is, you can always lose money, but you can lose at least a little. The easiest way to do this is to diversify your investment portfolio. Fill it with heterogeneous assets, stocks, precious metals, deposits, etc., with varying degrees of return and risk. Remember the 80-20 rule. 80% of your portfolio should be low-risk, low-yield assets, and 20% should be high-risk, high-yield assets. Do not invest all your savings in your investment portfolio. Not all financial assets have high liquidity. And if something happens, you will not be able to quickly find money to eliminate force majeure. Create a backup fund and keep it as available as possible. Don't invest borrowed funds. You cannot be 100% sure of the return on your assets, even if you have insider information. Playing with credit money is too dangerous to justify. It is better to invest less, but your own. Don't trust anyone and analyze the asset yourself before you trust them with your blood money. Everyone is wrong, and so are the top financial analysts. Trust only your gut.